Aadil, Zaman, and Aadil, you know, it's here's today's session, right? And it's just absolutely phenomenal. Again, momentum doing extremely well, but we also see some really great action in mid and small caps as well. And you say that it's ironic. I was reading your note. You were saying if people are underexposed to semis, don't wait, right? I mean, you like semis even though they've had such a big run already.
I think the semis, if you see it, you know, over the past decade, went up from 2% to 18% of the S&P 500, and they've had a parabolic move over the past 2 months. Fact of the matter is, a lot of people probably missed that out, and this pullback that you got up until yesterday was a great opportunity to start nibbling at it. So yes, certainly, use these.
Do you nibble or do you got to take full bites because they move so quick? I mean, if they get to your zone, I think you got to leap on them, you know, because if you nibble, you might nibble at 70, nibble at 90, next thing you know, you're nibbling at 120. But I get your point. You want exposure.
Yes, and if you look at the SMH, which is the VanEck semiconductor ETF, you know, you could just get broad exposure. Buy a piece and then see how it goes, and use the volatility to your advantage. Let it come to you.
You also say you like the barbell approach.
Yeah.
So you know there are other things out there less sexy, you know, than the semis, and you want people to be exposed there. One of my problems though is if you even look back to early March, you know, the names that are participating, stocks over the 200-day moving average keeps trending lower. I mean, the rally is so narrow. Yeah. Do you do a barbell approach with an equal amount of semis, hot stocks, with these, you know, decidedly unsexy stocks? Are they 50-50, or do you have these more as a hedge?
Yeah, so I think the investor sentiment right now, Charles, is that people have a little bit of a FOMO. They don't want to miss out, right? But when volatility hits, like what we saw over the past 5 days, boring is what works.
Right.
What worked out over the past 5 days? Healthcare, utilities, financials, they went up. So having a decent amount of your portfolio exposed there makes sense, but certainly have the semis, have the tech, have that exposure in a diversified.
Let's talk about some of the dominant risk factors you see out there: geopolitical, inflation, and Fed. You know, the geopolitical thing is intriguing because we keep getting different headlines with respect to the Iran conflict. I don't think it ever hit to the degree that it could. Oil could have easily gone and stayed at 120, 130. It didn't, and now it's starting to pull back. So what are we bracing for here? What are the main headlines you're looking for?
Well, the hope is that we get a resolution and that the market continues to go higher. But fact of the matter is, if you ask what is the biggest risk right now, it is the geopolitical situation because the economy is doing well. This is the big risk factor.
I got you.
And this is what you have to protect against. This is what you have to hedge against.
Let's talk about SpaceX. Okay. I was reading a note. You said that when we think about SpaceX, go back and think about Facebook. All right, folks. So Facebook, this is the infamous Facebook IPO. It absolutely cratered. And it was, in my mind, it was because they just got greedy. It was IPO'd here at this price. They lifted it in this price. They sucked out every nugget they could from the investors, which is Wall Street wants them to do. The financial media cheered that on, but the stock crashed. And it took a while before it started to take off.
Absolutely, yeah. So, you know, it's definitely a sexy story. SpaceX is definitely the hottest IPO right now. But at the same time, valuations are stretched. And sometimes it's a great story, but the opportunity might come months later. Facebook, Meta, a classic example, came out, dropped 50%. That was the best entry point.
Right.
So we're just telling clients that, you know, it is a good company, but have a little bit of patience. Use the volatility to your advantage. The best opportunity may come a few months down the road.
Before I let you go, so you already mentioned SMH on one side of the barbell. You also like oil. You like oil a lot, like ExxonMobil, Chevron, even XLE. What is it about oil? Because it feels like if crude starts to pull back, it's not necessarily helpful for these names.
Yeah, so I think oil is definitely, if we take out the headlines, most likely oil is going to remain elevated even if we get a resolution to the war. So these are great companies. We own them for clients: Exxon, Chevron, big companies paying a decent dividend.
Well, they pay great dividends.
They pay great dividends, and we deal with a lot of physicians who are older, and for them, dividends in retirement is important. But having this is really the only hedge you have right now against the geopolitical risk. So you should have a healthy amount of energy in your portfolio.
Great stuff. Great seeing you.
Great seeing you.
All right, let's keep rocking and rolling.